Hi guys, welcome back. So today we'll be analyzing the entire footwear sector. Like we will do the peer-to-peer analysis while taking the Q1 FY24 ka results. Almost all the companies ka result is out, the Q1 FY24 numbers. So we will see that. This quarter, or the whole Q1 FY24 quarter is the most normal quarter, right? Because if you go back and see in 2021 and 2022, there were a lot of headwinds. The entire footwear sector was more of a hot space, right? And right now, things have cooled down, things are becoming normal. Why is that so? Like, just to give you a brief, like a lot of y'all might know, I'm just gonna just give a summarized of what happened in 2021 and 2022, right? So the first thing that happened was, for the entire footwear segment, the government increases GST from 5 to 12%. That happened. The second thing that happened was because in COVID you saw and the war, the entire supply chain, there was a disruption there, right? Because of that, you saw that raw material prices that are there, especially rubber, which is one of the important raw materials that is used in the manufacturing of footwear. Even the prices of that rubber also increased like two to three times, right? So as a result, what happened? The footwear companies, the footwear companies' margins and PAT, they started getting skewed, especially for those where or those companies that were catering to a product range, below 500 rupees, or below 500 INR, right? Because this was a price point where they were unable to increase the price, because if they increase the price, the customers would downtrade, or would choose another brand or another product. Because when you talk about footwear that is in that 500 range, right, below 500 range, there is not really a lot of brand power you have there, right? So it's more of a necessity, those kind of footwear, right? So what happened was, in that range, of course, they couldn't increase the price. And on the other hand, also because of this GST and the inflation of raw materials, the entire the margins got skewed, and the profitability also came under a lot of pressure, right? Now that we're coming out of it, the 2023, we are at there, those things are of the past. Companies are quite accustomed to it right now. So all of those problems are in the past. That is not there. The second thing is, when you compare the 2022 numbers, the 2022 numbers were compared to 2021, and the 2021 numbers was compared to 2020, right? Like if you take a year-on-year basis, and both of these, 2020 and 2021, you had low base because there was COVID, not a lot of shops were open. So when you compare the 2022 numbers with either 2021 or 2020, you are comparing it to a quite low base. But 2022 was the most normal year, right? Like we were not having any COVID, no lockdown. So when you compare the financial year 2023 to 2022, right, you're getting a normal year comparison, right? Because things are back to normal. That's one thing. The third thing is, when you talk about the seasonality factor that comes with the entire footwear business, as you know, like Q3 is the best quarter, right? And followed by that, Q4 is a bit impacted, because it is the end of financial year, and people and the companies want to get rid of inventory, right? So there will be a lot of end of season sale. And Q1 and Q2 is monsoon season, again the leanest quarter for the entire footwear sector. So Q1 is the only quarter where nothing is happening, no end of season sale, no monsoon. Like it is the most normal quarter, right? So that is why this quarter is something, I wouldn't say unique, but also in a way special. So let's just go see, now that there is no pent-up demand, there is no COVID, there is no inflation, there is no seasonality, none of these factors, how have the companies in the footwear space have performed. So I'm taking 5 companies: Metro, Relaxo, Bata, Campus, and Red Tape, all of the 5, and we will do a peer-to-peer analysis on the same. I'll just share, I have a very small presentation. Yeah. So the first thing I would like to inform is, like, what are the metrics that we are going to see when you're doing the the peer-to-peer analysis. The first thing we will see is, of course, the top line and the bottom line. And along with top line, you're going to see 2 factors, that is volume growth and value growth. When you talk about the footwear sector, right, you need both. You need a volume as well as a value. Now, what is volume growth? Volume growth comes by by selling more of these products, right? Let's say if you were selling 120 pairs of shoes, just next year, you sell 140 pairs of shoes, more number of pairs. Value growth comes by increasing the price. Maybe you were charging for a footwear, let's say 300 rupees, and this say you're charging 350 rupees. Now, either way, both will contribute to the top line. So an ideal business will have both a volume growth as well as value growth. Like this is the ideal business, at least here in the footwear sector, at least in the footwear sector, because as you know, right, like you can't have unless and until you have a very strong brand, you can't have this unlimited, like there is no cap on pricing power at the end of the day, because most of the brands here cater to either, the bottom start of the society, or they cater to the aspirational classes, right? You take all of these brands. So they're not like hi-fi brands like, like Louis Vuitton or Gucci, where you can just cap the price as much as you want and people are going to flock to buy it, right? So there, of course, when you talk about those high-end premium brands, when you talk about it, there the volume growth has gone out for a toss. It's only value growth, but you understand it. But because you need a combination of two. I'll tell you why. If you have just value growth, what happens is you'll have scalability issues with the model, right? Like for example, Gucci and Louis Vuitton, there is a scalability issue. You can't open everywhere. That is why they do all of this demand supply thing. They supply a very less product, but the demand for that will be more. So that is how they control their quality and things. At the same time, let's say if you have only volume growth, right, and your value growth is not there, what is going to happen only because of volume growth? Tomorrow, like let's say a situation comes, right, like just like how the footwear sector experienced with the GST and the inflation and everything. And if you don't have that value growth is basically pricing power. What will happen? Again, your profitability will get skewed, right? Your business can go into a complete downturn, right? Everything that you have built for the last probably even 10 years can like go swish for a toss just because of one small incident, right? So that is why you need to have volume growth and as value growth also signifies that your company has a pricing power, right? So the both of it is very important. And the last thing we will see is the store expansion rate. What do I mean by store expansion rate is like, you take a CAGR as to like how many stores are added, you extrapolate it and see like, if let's say today you added 100, you have 100 stores, if you have to double the store count, take the number of years it takes to double the store count, and you should take a CAGR, like what is the CAGR of that. And this also gives you a better, this is also another way to extrapolate, how much the company can grow. Because with the existing stores that you have, there will, after 2 years or after 1 year, what the store rate will, the growth rate over there will be normalized, right? It will probably go back, to either in a mid teen digits, or like a high single digits, right? I mean, it will get normalized. So as a result, if you want to keep growing, the extra growth has to come from additional of new stores. So that in a way is a form of capex that footwear companies do, right? Because there will come a point you need to keep doing capex for your, or add distribution lines for your company to grow. So that is another indicator of store expansion. So first, let us see. I believe I'll just give a summary of like, how every company is different from the other. Like, I think that will, I mean, although I think I've covered every single of these companies in detail in either of my videos, I'll just give a summary as to like what are the products and how is every company different, right? So if you talk about Metro Brands Limited is an aspirational brand, right? They cater to how do I tell? They cater to the aspirational people. Here they do have a pricing power, because a person who's buying 4,000 rupees ka Crocs, he will not, he won't care if agar kal 4,000 se 4,500 bhi hoga, right? So Metro has majority of the sales, I think around 49% of the sales coming from about 3,000 rupees ka category, right? They have different brands like Mochi, Crocs, Walkway, FitFlop, all of these again above the average price range will be about 3,000 rupees, and they cater to a wide variety of audience, the men, women, and the children. Wide variety of audience, like they have a brand presence also. So that's about MBL. And also not just that, they have everything. It's like a one-stop shop. You can go get all kinds of footwear, whether it is heels, flats, shoes, everything, right? They recently even acquired Fila, which gives them an entry into the entire sneaker segment also, right? The next thing is we have Campus here. How is it different from MBL? Like if you go to Metro Brands Limited, you get everything in Metro Brands Limited, right? Like I told you, all kind of shoes and chappals you can imagine, you get it. Whereas if you go to Campus, in Campus you're going to find only shoes, right? They do have a certain portion of the revenue coming from the open footwear category. But open footwear, it is quite insignificant right now when you compare, because majority of the business is coming from closed footwear, that is your shoes, that is the sneaker segment. Now campus has positioned itself like, in India, there's only like either two brands. Either if you want, the really good sneakers, you go to Nike and Adidas, and the other end of the brand is like Sparks, like which cater to below 1,000 rupees ka category, right? So there was a huge gap missing where you get good quality but also at a decent price. So that is where campus comes. They are like an alternative for Nike and Adidas, and all the top premium brands you can imagine. Relaxo sells chappals. They have mostly majority of their products come in under below 1,000 per category, right? Not below 1,000, actually below 500 rupees per category. They sell, the Hawaii chappals. You would have seen, right? Akshay Kumar, and also I think Salman Khan. I think both of them come in this ads. I'm not sure. I think they do, right? So Relaxo is one, and Relaxo was the most affected when you talk about this whole GST car thing and and the inflation, because like I told you, they are selling chappals below 500 rupees ka category, and because of this, what they didn't have was a pricing power, value growth nahi tha. Iske wajah se, like coming back to the first point, this is why they the entire business that was there for the last 10 years, whatever they had created, had gone for a complete toss. Next we have is Bata. Bata also, Bata is similar to Metro Brands Limited, like I told you, like, it's a one-stop shop. You get men, women, children. But the thing is, Bata doesn't have that aspirational brand. I think most of you also, right, when you think about Bata, what do you think? Like, I think it's, we think about any footwear that ranges between 500 to 1,000. Even in Bata also, when the entire situation happened, like with the GST and, the other things, around 45% of their product portfolio would come under 500 rupees. So even these people were also heavily impacted because of the entire fiasco or the situation that happened, right? So that's about Bata. And Bata ka also, now if you see the growth that is there, that Bata has, it is primarily driven by hush puppies, floats. I think there's another called Red Label and Claire. These are the four. Bata has many brands also. So these are the four premium brands. Like if you go to hush puppies, you go get a loafer. It starts around 2,500 to 3,000 ka category. So even there also, their the majority of the product portfolio or the revenue is driven by this kind of product portfolio. And after this fiasco that happened in 2021 and 2022, they are focusing on getting a more of a brand presence, like so they can cater to like Gen Z and millennial. And not just that, but how do I explain this? Not just that, but the average price of the footwear also has increased. Like now I think the ASP is around 700 rupees, unlike earlier, which it was 500 rupees, right? I think one good thing would be like just go. I think there are many Bata showrooms in and around. Just see, like I think take your mom and go. I think they're like really good at this. They can tell you like how prices increased here. The last thing is Red Tape. Red Tape, in a way, it's not. Red Tape has three brands: Red Label, I think White Oak, and I'm not sure there's another brand. In a way, Red Tape I can't compare to MBL also, because Red Tape has both. Like it has a brand, but it also not too expensive, just like Metro Brands Limited, right? On the other hand, with Red Tape, the difference with other companies are like here a very small portion of the revenue comes from accessories. Like example, if you talk about Metro Brands Limited, the accessory portion contribution to revenue is 11%. Campus ka to koi bhi accessories nahi hai. Relax also the same thing. Bata also, I think it's around the same only as Metro Brands Limited. Red Tape ka portion is higher. I think it is around 50% or 40%. I think the accessories and clothes, they even have that. And I think the other 50% is driven by footwear, right? So both of these things are there. Like so, Red Tape somewhere falls in between this and also a more of a clothing retail company, right? So yeah, and I think again the value of Red Tape goes up after they have demerged with Mirza, as Mirza was a leather business and it was such a drag. And Red Tape like all of these other companies, if you see MBL, Campus, Relaxo, and Bata, their operations are more in India. Whereas Red Tape there is a certain portion of their segment, or a revenue segment that comes by selling their shoes, in places like London, Australia, Maldives, and Bahrain and other Middle Eastern countries. countries also. So there is not a lot of information about Red Tape because, it's a newly listed company. Like whatever I have, I'll try to cover it with that, right? So this is the entire, the summary of like how each and every brand is different from the other, or the product portfolio is different. Now, if you see in terms of revenue also, you can see that there are two brands that have really performed well. One is Metro Brands Limited and the other is Red Tape. So Metro Brands Limited had a revenue growth of 15%, whereas Red Tape had a growth of 28%. Relaxo, on the other hand, 1 second, let me find. Yeah, Relaxo, on the other hand, had a growth of 10.47, and Bata was flat around, I think 1.9. It's almost flat only. Campus also had a mediocre result. It's hardly 4%. This entire picture, the fact that you see that the only two companies that are performing well is Metro Brands and Red Tape, just also clearly shows you that the fact that, premiumization is a trend that you witness these days, right? Like the category of people who are not affected by inflation are the one that, is driving these businesses. Like I told you, like if you, a person who's buying Moche ka 2,000 rupees ka shoe won't care if, 2,500 if the prices increase. Similarly, Red Tape also, right? So, those companies that are catering to the premiumization brand, you can see that the revenue growth for them is higher. If you compare with Campus also, the reason for Campus also having this low growth is, like I told you, they are positioning themselves as a value brand, for people who can't afford Nike and Adidas. But you do realize, right, like as things get better, like as the upper middle class moves, as the aspirational part of the a part of the country grows, of course the how do I tell you, the focus will be more on buying better things, right? So a person who probably is buying Bata today will tomorrow, like Bata ka North Star ka sneakers, tomorrow as their income power grows, they would want to how do I tell you, they would want to buy Nike and Adidas, right? So that is the thing. So that is why you see, and this is also one of the reasons why they don't have that value growth, like they don't have that pricing power, because if they increase the pricing here also a little bit, then of course, they're going to come in direct competition with Nike and Adidas, who's these days, whose also shoe starts between 3,000 to 4,000. And that is the reason, like then what is the difference between Campus and Nike, right? Like people can go and get there. The next thing we will see is in terms of PAT, like if you see the PAT growth, of course, right? Red Tape, if you see, Red Tape has grown the highest by 64%, right? Here, if you see, Bata has degrown, but MBL, if you see, you might look at the first stance and think like, oh, Metro Brands has degrown, so it must be bad, but that's not the case. Metro Brand recently acquired this brand called Cravtex, which deals with Fila, the footwear company, and because of that acquisition and operational cost, because of that, since the entire thing was funded internally, they didn't take any debt. Because of that, it has, it has gone into, I would say, it has reported a loss, and they have spent last quarter 14 crores, this quarter 14 crores. It's because of that, only that, right? Otherwise, if you exclude that, they're still profitable on a year-on-year basis, right? In terms of Relaxo, of course, now they're doing well. If you see that Relaxo ka profits also has grown by 45%. Then the most important metric comes in the entire footwear segment is you see the volume and the value growth, right? Like I told you, an ideal combination would be, where you have both a volume growth as well as value growth, right? If you see, let me start with Campus. Campus ka volume growth was hardly 0.7%, very, very mediocre to say. And the entire aapka jo top line tha, which hardly grew by 4%, that that is driven mainly by increase in price. That is mainly driven by increase in value growth, right? I think they sold 5.1 million pairs this quarter. I think last year same time it was also the same, like 5 million pairs. So that's that. Relaxo ka problem is this. Relaxo ka problem is, on one hand, they couldn't keep up. They couldn't keep up with the increase in price, increase in raw material ka price, increase in GST. And, to protect their margins, they had increased the price. But once they increased the price, what happened of their products? People stopped buying that, right? And now they have reduced the price. They have taken a cutback in price. This clearly is a negative thing for me because, as a brand, you just don't have pricing power. So, kal bhi ye bhi situation aa sakta hai, and then, again, you might go for a havoc. But having said that, their volume that is there, it has gone from 3.1 million pairs pairs they were selling, I think, same time last year. And right now, I believe it is 5.1 million pairs. If you see that also, like one of the reasons, that volume growth, it's not significant for me is because you had to cut down on your price. So in order for that volume growth to come, right? That is one thing. The second thing is, you were, this relaxo was beaten down so heavily during the entire process. During this entire time, the base was also so low. That 3.1 million is a very low base for them. And you're comparing with anything compared with the low base, the change will look huge, right? Red tape, sorry, not red tape, Bata also the same thing. The volume growth was absolutely zero. And whatever the hardly that 2% growth that you saw came from value growth. If you see from last year to this year, the value growth has been 3%, right? So both of all these three, as you can see, either the volume growth is missing or there has been a complete value degrowth, right? That is it. Next comes is MBL and red tape. If you see, MBL has had a high single digit volume growth around 9%. The reason for that is like in Q1, majority and the other 7% came from value growth. The reason for here, to be primarily driven by value growth is, if you see in Q1, majority of the sale comes from two products. One is FitFlop and the other one is Crocs, right? Because Crocs are mainly used during monsoon season, and Crocs and FitFlop, both of this, because FitFlop ka jo average price hai, that is around 6,000 rupees. It starts from 6,000 rupees, right? Similarly to Croc also, Crocs ka average price hota hai 3,000. Because both of these categories have such a high starting price, and average price is so high. Because of that, this quarter is mainly value driven. Otherwise, you can find the volume growth to be around somewhere between low to mid digits. But since in Q1 the primary sales are driven by Crocs and FitFlop, that is why you're seeing that the value growth and the volume growth are are equal. Otherwise, even volume growth of Metro is around either in double digit, somewhere between low to mid double digit. In red tape, I don't have data, as I told you, like the company doesn't give out any, it just recently got listed, and earlier also they wouldn't give any investor presentation or con calls. They wouldn't have it. But having said that, if you're talking about a 28% growth, let's say when you have, I would say for a brand like Red Tape, I don't think it's possible for you to increase your value, like let's say the value growth, like more than double digit. Even if you take conservatively out of 10%, out of 28%, let's say you have a double digit value growth, right? Like let's say 10%. It still shows that you have somewhere around 15 to 18% coming from volume growth, which is still great. Like if I'm having double-digit volume growth, high ROE company, great sales, great profitability, I mean, it is just a recipe again for multi-bagger, right? So that's about volume and value. Here also you can see, right, like when you compare the revenue and PAT, the companies that had greater revenue and PAT are also having the volume growth, and the value growth is higher only to those companies. The next thing is we will see the store expansion rate, right? Like at which, like I told you, store expansion rate is like CAPEX. That is where your additional growth or the future growth is going to come from, right? If you see campus, ka problem is that the campus does a lot of distribution channels. I think 57% comes from distribution channels, and 37% comes from online e-commerce, and the rest comes from offline stores. So I can't really compare this with the others. Similarly with Relax also does a lot of distribution. I mean, there is nothing to see forward, right? Like campus ka kya hi dekhne hai, hardly you're having 0.7% का volume growth. इसके बाद आप कितना भी stores खोल लो, कितना भी करो, like if the existing volume growth only is not there, what is the point, right? Bata का problem is this, Bata is a well-known and established brand. Like the distribution has scaled up immensely. Right now they have 2,100 stores. So let's say if you have to multiply it, you have to like 2,100 stores, and let's say if you have to increase it, double the store count from 2,100 to 4,200, right? And this quarter they added 47 stores, right? So it's around, let's say 50, 200 stores in a year. How long will it take you to reach if you're adding 200 stores every year from the current levels of 2,100, if you have to go to 4,200, if you extrapolate the number of years and then take the store expansion rate, CAGR, it comes up to around 6.86%. So that is indirectly telling you like this company has a potential to grow between 6 to 10% CAGR for the coming years, right? So this for me, because even though they might have a volume and value growth in forward, sometime in the future, the fact that the store expansion rate or the growth rate, if I have to extrapolate, if I'm getting around 6 to 10%, it's just not worth for me to buy. Like these two get, campus goes out because there is no volume growth. Relaxo ka problem is, of course, the kind of valuations they have, and there is no pricing power. This goes again out of the toss for the out of window for me. Bata ka problem is, the incremental growth that comes, that is very low. It's hardly 6 to 10% CAGR. That goes out of the window for me. Now, after that, if you see the only two brands in terms of revenue, in terms of PAT, in terms of volume and value, and in terms of store expansion that exist is MBL and Redtape. Now, when I talk about Metro Brands Limited, if you have followed this company, because I've been following this company for a very long time, since the time the IPO came, and if you listen to Nissan Joseph at that time, who's the CEO of Metro Brands, they had a vision. I think at that time they had around 600 stores, like when before the IPO, and they were going to add 290 stores in the matter of 3 years. So if you take the store expansion because CAGR, it comes up to 18 to 20%, and it is exactly what they told they will grow by. Like when they came up with the IPO, they were like, 18% is something that we are targeting, and that is great, right? And if you see, the store expansion is always on track, right? If you go back and see the entire FY23 the store expansion rate, because they are planning to open 290 stores in 3 years. So that's roughly around 80 to 90 stores in a year. So that means around 20 to 25 stores in a quarter, right? And if you see, every single time you would see like 27 stores. In Q3, they opened the highest stores, around 47 stores, every single time, doing the best that they can. And even something that is commendable is like, see, I don't want my store expansion rate that comes at the cost of margins. Like that should never happen, right? So even if you see, the gross margins, that is the sweet spot for Metro has always been between 55 to 58%, and they are well able to maintain that in spite of the aggressive store expansion that they're doing. So if you see in Metro, of course, the volume, value, revenue, PAT, and the store expansion rate is, if you see the 18% growth, the store expansion rate is around 18% growth, and the company is also telling we will grow at 18% CAGR, right? That is what they're telling. So you can see that the growth expansion rate is matching with what the company is telling, in future, how they want to grow. Redtape ka thing, Redtape, I think right now they have, I believe it's, I think I might be wrong here, but I think they have around 350 stores. I am not, again, like I told you, because of lack of information, I believe a majority of chunk of their revenue comes also from e-commerce, through Flipkart and Myntra and other e-commerce websites. I believe they're more into like e-commerce and not just retail retail outlets. So this is something that I'm really excited to see. I excited to see as to like how their store expansion would be, because if you see, Redtape really clears the entire checklist, right? Like the demand, they have a lot of tailwinds. They have the revenue profitability is great. Not just that, the volume and value growth is there. There is operating leverage also, and they also have a brand power, like unlike the other brands, the only person here who's having a brand power is MBL, and followed by Bata. But even here also, Redtape also has a really good brand presence. So this is something that I'm really excited to see, like how Redtape store expansion will be there. I would really love to have Redtape in my portfolio. I would, but right now, since there is lack of clarity, let me just stop this. Yeah. Since there is lack of clarity as to like, in terms of like, again, like the volume and value growth, or in terms of the kind of store expansion that they're targeting and how many cities that they're targeting and things like that, I am a bit reluctant. I'm a bit reluctant to buy it. And the other thing is also like Q2 is, like I told you, is the leanest quarter. Like I just want to also track their performance in Q2 and see like how they perform, like even in monsoon season, like how the year-on-year performance is. And hopefully, the company is more transparent in terms, like they get out IP and con call and things like that. If they can be more transparent, that that would be great. But having said that, right, if you see the just ending this whole thing, like if you see the peer-to-peer analysis, you see that Metro Brands Limited and Redtape really do stand out. And Metro Brands Limited, of course, has a really great team, has a really great management that is leading them. They're a very financially disciplined company. If you have an opportunity, do listen to the con call. Like you just listen to the way Nissan Joseph speaks, and you will understand like what I'm trying to convey, right? So of course, if you see the entire, just to wrap it up, like the entire footwear segment, like Metro Brands Limited and Redtape really do stand outside, out of the crowd, stand outside the herd. And yeah, at least in Q1 FY24, they did perform well. And let's see how the entire segment performs in the next quarter. So that's that about the entire footwear segment. And yeah, I hope you liked it, right? So I see you tomorrow again with something another. We'll discuss something new. And until then, goodbye. Bye bye. Have a nice day.